and welcome to YP Investors Quick Tips. In today's episode, we will learn about protecting yourself from earnings. Now, every company releases earnings quarterly, and this means they are releasing earnings 4 times a year. They have a scheduled earnings date for each quarter, and they will share how much per share that they earned throughout that quarter. Now, the earnings results can result in huge swings in the price of a stock, and they are very unpredictable. So you definitely want to protect yourself if you have a short-term contract or just being safe and protecting yourself in general is a good idea. Even if the earnings expectations are beat, the stock price can still go down. And the same goes if the earnings expectations don't come out to what was expected, they're lower than expected. The stock price isn't guaranteed to go down, but it could go up, which is why you want to protect yourself and have some plan of action for earnings. So let's pop over to YP Investors and let's check out some stocks that recently had earnings. Let's go to the stock selector tool by hovering over the tools tab, clicking stock selector. Once that loads, let's type in Glue, G-L-U-U. This is a software company that had earnings this week. And if we scroll down, we'll see the technical attribute score, chart data, earnings information. So the next earnings date is going to be in July 29th. Let's see. So before earnings this week, Glue was at about between 11 and 11.50. And then once earnings was announced, after market close, it dropped down significantly in the after hours trading. And the next day, Glue was down 17% on the day. So what can we do to protect ourselves in this situation? Well, what you can do is you can purchase a put contract. You want to buy a put option contract. And what you would do is, so currently the price of Glue was at about between 11 and 11.50. You buy it with a strike price at $11 or even higher if you want to. That's just going to cost a little more, but it will protect you more. And for each contract, you own 100 shares, or you have the right to sell 100 shares at that price. So, that's for a call. For a put, you have the right to sell 100 shares at the price of $11. So this protects you, because if the price drops down to $9, which it almost is right now, you can sell those 100 shares at $11 still. So this means if you own 100 shares of Glue, you are able to sell these shares at $11 no matter how far it drops. That's how you're protecting yourself. Now there is a premium you have to pay for this put contract, and it's going to be expiring in a certain amount of time. And what you want to do is you want to buy the shortest contract, because earnings happens and the reaction to the earnings will happen quickly. So you would want to buy this put contract the day before or the day of, anytime before earnings, and just go for the shortest term contract you can. This will keep your premium price down for that put option. And it depends on how many stocks you own is how many options contracts you would want to buy. So if you owned 500 shares of Glue, then you probably would want to buy 5 contracts, which gives you control over 500 shares. And now this doesn't mean you should always do this to protect yourself, because if you're in a stock for the long term and you use the technical analysis and we can see that Glue is in a positive trend, then you shouldn't worry about the earnings as much unless the stock was closer to the resistance line and it started crossing that resistance line, then you might want to worry about that. But if you're in the stock for the long term, you might just ignore the earnings and it might bounce back eventually. If it's a good positive technical stock, it's going to bounce back and it'll be fine regardless of earnings. This way you won't miss out on a big positive swing from earnings. You still wouldn't miss out with buying a put contract. You would just lose the premium you paid, but that's just basically buying insurance for all of your stocks. And another option could be if you have glue contracts that you bought as calls, meaning you make money as the price goes up, and a significant drop in price could really wipe you out, you might want to just sell those call contracts before earnings. Because with options call contracts or put contracts, if the price in the stock goes opposite in the way your contract is, then you're going to end up losing all your money in that contract if it exceeds the strike price. So for our put contracts, if glue earnings came back and they actually went way up above 11, then our contracts are going to be worth nothing because no one's going to want to buy. We can't sell our shares at $11. We would have to sell them at more, but we own the shares anyways, so we would just lose that premium. So let's take a look at Team. This was one where once the chart's generated, Team had earnings recently as well, and it was at about 116 before these earnings. Now once the earnings came through, the price in Team's stock dropped way down to 102. Since then, Team has recovered and is way up. It's actually up to 125 today, up 6.7%. And so this demonstrates how if a stock is in a positive trend and you're in it for the long run, you might not need to do any protection at all and just continue to hold it, and you know it's going to be good, and odds are if it's in a positive trend, it's going to stay in a positive trend. Earnings are just a minor fluctuation in price, but it's a good way to protect yourself if you have certain types of contracts or your stock is close to that resistance line. So our YP quick tip today is to always have a strategy no matter what investment that you're in. So if you're going to be in just buying stocks and holding them for the long term, then just know that you're going to do that, and you're going to not worry about the earnings unless the price is going to drop below that resistance line, and it will switch to a negative trend. On the other side, if you're doing more swing trading or short-term trading and you have call options, well, you might want to sell out of that call option or buy a put option to protect yourself from earnings, because they're such short-term, because you're in such a short-term investment that a major price swing to the negative side could really affect you if you're not going to be holding it for the long term. Thanks for joining us today, and I hope this was helpful to you. If you're not a member of YP Investors, we'd love to have you join. We have a free trial membership you can sign up with, and we'd like to wish you good luck on your investments.